Imagine inheriting a lake house worth millions, but facing a tax nightmare. Sounds tricky, right? Well, not anymore. Buckle up as we navigate the twists and turns of inheritance planning, uncovering secrets that could save you a fortune. Let's unlock the door to financial wisdom and turn that inheritance into a lasting legacy. Ready to transform your financial future? Let's get started. Scenario. Let's picture a common yet complex situation many of us face. Meet Sunny, a young professional whose grandparent owns a picturesque lake house, a family treasure with not just emotional value, but also significant financial worth. Originally purchased for $100,000 about 4 decades ago, this serene property is now valued at a staggering $2 million. Now Sunny's grandparent, looking to pass on this legacy, wants to gift this lake house to Sunny. At first glance, it seems like a windfall, a generous act of passing down generational wealth. But here's the twist. Without the right financial planning, this seemingly wonderful gesture could lead to a hefty financial burden for Sunny, particularly in terms of capital gains tax. This is where our journey into inheritance planning begins. How can Sunny navigate the situation to not only honor the family legacy, but also to ensure financial prudence? Stay tuned as we unravel the complexities of inheritance, tax implications, and the smart strategies to handle such a significant familial and financial decision. This introduction sets the stage for the video, presenting a relatable scenario that effectively leads into a deeper discussion on financial planning for inheritance. Understanding capital gains tax. Before diving into Sunny's situation, let's first demystify the concept of capital gains tax, a crucial factor in inheritance planning. In simple terms, capital gains tax is what you owe the government when you sell an asset, like property or stocks, for more than you originally paid. It's a tax on the profit you make from the sale. Imagine buying a painting for $1,000 and years later, it's worth $10,000. If you sell it, the $9,000 you gained is subject to capital gains tax. Now, apply this to real estate, like Sunny's lake house. Purchased for $100,000, its value skyrocketed to $2 million. The $1.9 million increase is the capital gain. If Sunny inherits and sells the house, she's liable for tax on this gain. This can be a substantial amount, drastically reducing the actual benefit of the inheritance. It's not just about receiving an asset, it's about understanding the financial implications that come with it. This is why understanding capital gains tax is pivotal. It impacts decisions on whether to keep, sell, or even accept an inheritance. Next, we'll delve into how Sunny can smartly navigate this to avoid a hefty tax bill, a scenario many inheritors face. Gift versus trust fund. Now that we understand capital gains tax, let's explore Sunny's options receiving the lake house as a gift versus through a trust fund. A direct gift seems straightforward. Sunny's grandparent simply transfers ownership of the house to her. However, this approach has significant tax implications. The key here is the property's original purchase price, or cost basis, which in this case is $100,000. If Sunny inherits the house as a gift, this low-cost basis carries over to her. So when she sells the house for $2 million, she faces a hefty capital gains tax on the $1.9 million profit. But there's an alternative, a trust fund, specifically a living trust. By placing the property in a living trust with Sunny as the beneficiary, the ownership remains with the grandparent until they pass away. This approach offers a unique tax advantage. When the property is eventually transferred to Sunny upon her grandparent's passing, the cost basis is stepped up to the current market value. This means if Sunny sells the house immediately, her capital gains tax could be significantly lower or even non-existent. This distinction between a gift and a trust fund is crucial for effective financial planning in inheritance situations. Benefits of a living trust. Delving deeper into the option of a living trust, let's uncover its benefits, especially in the context of Sunny's inheritance scenario. A living trust is an arrangement where an individual, the trustor, places assets in a trust for the benefit of another person, the beneficiary, which in our case is Sunny. The major advantage, control and tax efficiency. While the trustor is alive, they maintain control over the trust assets, in this case, the lake house. This means Sunny's grandparent can continue enjoying their property without any change in ownership status. But the real benefit shines through upon the trustor's passing. The assets in a living trust bypass the lengthy and public process of probate, ensuring a smoother and quicker transfer to the beneficiary. Most importantly, as we touched upon earlier, is the step up in basis. Upon inheriting the property through the trust, Sonny benefits from the property's value being reassessed at its current market value. This step up minimizes potential capital gains tax dramatically if she decides to sell. For inheritors like Sonny, a living trust presents a strategic way to manage inheritance, combining flexibility, control, and tax efficiency, all essential for preserving and maximizing generational wealth. Estate tax implications. When it comes to inheritance and legacy planning, there's a critical player we haven't yet discussed: estate taxes. This tax is levied on the transfer of the estate of a deceased person. It's different from, and in addition to, capital gains tax, and it's based on the total value of the deceased assets. Think of it as a tax on the right to transfer property at your death. For substantial estates, this can be a significant sum. However, savvy planning can help minimize its impact. Strategies like gifting assets during your lifetime or setting up certain types of trusts can reduce the size of your taxable estate. It's vital to be aware that estate tax laws vary widely depending on your location and can change over time, making it essential to stay informed and seek expert advice. Navigating estate taxes is key in assuring that the maximum possible value of your legacy is preserved for your beneficiaries. Explaining step-up in basis. A crucial concept in our discussion is a step-up in basis, a tax provision that can significantly impact inheritance, as in Sonny's case. To understand this, let's revisit the concept of basis. The basis is essentially what an asset was originally purchased for. In the case of inherited assets, the step-up in basis adjusts the value of the asset from the original purchase price to its market value at the time of the original owner's death. This is pivotal for tax purposes. For instance, Sonny's grandparent bought the lake house for $100,000. If Sonny inherits it through a living trust, the basis steps up to its current value of $2 million. Why is this important? When Sonny eventually sells the house, the capital gains tax will be calculated based on the stepped-up basis. If the selling price is close to the stepped-up value, the taxable gain is minimal, drastically reducing the capital gains tax burden. This step-up in basis can lead to significant tax savings, making it a key strategy in estate planning. It's a powerful tool, especially for high-value assets like real estate, ensuring that beneficiaries like Sonny can maximize their inheritance. Legacy planning strategies. Beyond understanding trust funds and the step-up in basis, effective legacy planning encompasses a range of strategies. Legacy planning isn't just about distributing wealth, it's about passing on your values, wishes, and legacy in a way that benefits your loved ones. One fundamental aspect is creating a well-thought-out will. A will clarifies how you want your assets distributed, minimizing confusion and potential disputes among heirs. Another key element is designating beneficiaries for your financial accounts, like retirement funds and life insurance policies. This direct designation often bypasses probate, simplifying the transfer process. Moreover, consider the potential of life insurance policies. They can provide a tax-efficient way to leave a financial legacy, offering a payout that's generally free from income tax for beneficiaries. For larger estates, exploring options like charitable trusts can be beneficial. These not only support philanthropic goals, but can also provide tax advantages. Remember, legacy planning is deeply personal and varies greatly depending on individual circumstances. It's about creating a plan that reflects your wishes and ensures your legacy is carried on in the manner you envision. Engaging with estate planning professionals can help tailor a plan that aligns with your goals, ensuring a lasting and meaningful impact. And that's a wrap on turning inheritance into a legacy without the tax woes. Remember, with the right strategy, every inheritance can be a stepping stone to a stronger financial future. We've journeyed through trusts, taxes, and legacy plans, unlocking secrets that make a real difference. Don't just inherit wealth, inherit wisdom. Stay ahead of the game and keep your legacy growing. If you've enjoyed this financial voyage, hit like, share, and subscribe for more savvy tips. Stay smart, stay informed, and most importantly, keep building your legacy. Until next time, keep your financial dreams alive.